For the past 4 months, the U.S. stock market has been hitting record after record, new all-time highs week after week, until one Donald Trump tweet wiped out $1.7 trillion from the S&P 500 in a single day, threatening 100% tariffs on China. A day later, Trump walked it back. The market bounced. Everyone moved on as if nothing happened. But here's what Wall Street isn't telling you. Beneath the surface, something is breaking. And if you know where to look, the warning signal is flashing red. Because while stocks are making new highs in dollar terms, they're making new lows when measured in gold. In fact, the S&P 500 is hovering near its lowest level versus gold in over a decade. This divergence is telling us something critical about what's coming, and understanding it could be the difference between protecting your wealth and watching it evaporate. Let me show you what's happening. When you measure the S&P 500 in dollars, everything looks fine. Record highs, bull market intact. But when you measure the same index in gold terms, the picture completely changes. This divergence between stock prices in dollars versus gold started accelerating in early 2024. It got worse during the first tariff announcements at the beginning of 2025. And now, with Trump's recent 100% tariff threat, it's intensifying even further. Here's why this matters. Historically, periods where stocks decline in gold terms while staying flat or rising in dollar terms don't last. Eventually, the dollar price catches up to reality. Look at the early 2000s during the dot-com bust. Stocks were falling in gold terms before they collapsed in dollar terms. The 2008 financial crisis showed the same pattern. And if we go back to the 1970s, we see stocks declining versus gold during that entire decade of stagflation and dollar crisis. The pattern is always the same. Gold leads, stocks follow. Normally, when capital floods into gold, it means there's a flight to safety. Investors are running from risk. Stocks fall as money exits. But today, we're seeing something different and far more dangerous. Today, both gold and stocks are rising together. The stock market has completely shrugged off the massive risks staring it in the face. The extreme trade uncertainty, the collapse in consumer sentiment to levels historically associated with recessions, the tariff chaos creating havoc in supply chains. None of it seems to matter. Stocks keep climbing. But that doesn't mean we should ignore what gold is telling us. Because Trump's 100% tariff threat on China, even though he backed off almost immediately, reveals something critical about where we're headed. A 100% tariff would push the effective tariff rate on Chinese goods to around 140%. That level doesn't just hurt trade, it kills it. It makes any business importing from China mathematically unprofitable. This kind of scenario would trigger an economic depression, not a recession. Now, investors know Trump probably won't follow through. This is negotiation theater. That's why stocks didn't crash in a straight line. But here's what people are missing. Every threat like this fragilizes the relationship between the US and China further. It normalizes the idea that complete economic decoupling is possible. And eventually someone will follow through. Here's something most people don't understand. China is in a much stronger position today than it was when this trade war started. Since the trade war began, Chinese exports to the US have dropped 27%. That sounds devastating. But here's the twist. China's exports to the rest of the world have grown so much that they've completely offset the US decline. Total Chinese exports grew 8% last year, despite the tariff assault from Washington. What this represents is a fundamental realignment of global trade. US and Chinese economic interests are diverging. America is becoming less important to China's economy, and that means China has less reason to compromise. Eventually, if these interests diverge enough, a US president, whether Trump or someone else, could be forced to actually sever economic ties with China completely. The fact that this is even on the table represents a massive deterioration in the global trade system that built the prosperity of the last 40 years, and that will absolutely impact economic growth. The only question is when. If you're starting to see how fragile this entire system really is, hit that subscribe button right now and smash the like button. Because what I'm about to show you next explains why stocks are still rising despite all of this, and why that won't last forever. Let's continue. So why isn't the stock market reacting to any of this right now? Simple. Corporate profits are at all-time highs. But it's not because tariffs have zero impact. It's because there are other massive forces propping everything up, at least for now. First, the US government is running a $2 trillion annual deficit, roughly 7% of GDP. That's peacetime spending at wartime levels. All that money floods into the economy, keeping growth artificially resilient and boosting corporate revenues. Second, the Federal Reserve has been cutting interest rates, lowering borrowing costs for businesses, and loosening financial conditions across the board. Cheaper money means higher asset prices. Third, corporate profit margins are at record highs. Businesses have successfully passed costs onto consumers through inflation while keeping wages relatively suppressed. This allows earnings to grow easily and shareholders to accumulate wealth at an accelerating pace. Now here's the key insight. These forces don't just drive stocks higher, they drive all financial assets higher. That's why gold and Bitcoin, which aren't directly tied to economic growth, have been climbing right alongside the stock market. In fact, gold and Bitcoin have been rising faster than stocks over the past 2 years. This clearly shows what's really happening. It's not economic strength driving markets. It's monetary expansion and financial engineering. We believe these forces will probably continue for at least another 6 to 12 months. Government deficit spending isn't stopping. The Fed isn't hiking rates aggressively. Corporate margins remain elevated. So asset prices will likely keep grinding higher in the short term. But, and this is critical, the foundation is cracking. Every tariff threat, every trade disruption, every step toward economic decoupling weakens the system supporting these valuations. The stock market in gold terms is telling you that real purchasing power is being destroyed even as nominal prices rise. Your portfolio might show bigger numbers, but what those numbers can actually buy is shrinking. This is the early stage of a currency crisis disguised as a bull market. Now, we're not saying sell everything and hide in a bunker. Timing these transitions is extremely difficult. But we are saying you need to understand what's actually happening so you can position yourself accordingly. On October 9th, we booked profits and closed a significant portion of our positions because we saw the risk of a short-term correction increasing. We raised cash to protect gains and give ourselves dry powder. Yes, sometimes that means missing a few percentage points of upside. But risk management isn't about maximizing every gain. It's about surviving long enough to compound wealth over decades. We've already been using this recent pullback to redeploy that cash selectively into specific opportunities we think have substantial upside in the coming weeks and months. Here's the bottom line. The stock market looks strong in dollars, but it's weak in gold. That divergence has historically been a warning sign that eventually resolves with dollar prices catching down to reality. Trump's tariff threats, even when walked back, are systematically weakening the global trade system that supports current valuations. China is decoupling from the U.S. economically, which removes a critical pillar of American prosperity. Meanwhile, massive government deficits, Fed rate cuts, and record corporate margins are temporarily masking all of this by inflating asset prices across the board. This can continue for months, maybe longer, but it can't continue forever. The question isn't if the foundation cracks, it's when and whether you'll be positioned correctly when it does. The smart money is already hedging. Gold is telling you that story. Are you listening? If this completely changed how you see what's happening in markets right now, make sure you're subscribed to the Wealth Forum and hit that like button. Because understanding the difference between nominal gains and real wealth protection could be the most important financial decision you make in 2025. The warning signal's flashing. The question is, will you see it in time?